Kevin McArdle, welcome to Built to Sell Radio.
Thanks, John. Good to be with you again.
I've wanted to have this conversation for a while because two of our past guests, Laura Roederer and Arvind Danielle Carl, sold their company to you. So I'm excited to hear from the other side of the equation what it's like to buy businesses from Built to Sell Radio guests. Thank you for joining.
That's really fun. And I'm a big fan of all those people. And I love telling both those stories just because it's makes me smile, as you can see now on the video.
Yeah, for sure. So we were talking offline, you bought 45 different businesses, big and small. You've also sold a few of those companies. And so I'm going to ask you for our conversation today to kind of wear your business buyer hat. I'm going to ask you questions about, what do you look for in a company? What are some of the do's and don'ts from a buyer's perspective, what you see entrepreneurs doing both good and bad. So if folks are looking to try to think about and get inside the head of an acquirer, they can use your advice. But before we get there, I'd love for you to just explain in layman's terms your business model. Like, how do you make money?
Yeah, so it's actually pretty simple. We are a software holding company. So we're focused on acquiring software businesses, north of $1 million in annual recurring revenue. And it's a buy and hold model. We want to acquire and operate great businesses, and we are under no obligation to ever sell those businesses.
So how do you make money then?
We're buying profitable businesses. So the money is built into the model. And if we're good at our job, we buy a business that's successful and profitable, and we can help make it more successful, whether that means grow faster or be more profitable, or ideally both.
And do you buy 100% of the company or a portion of it? What's the structure like?
We like to buy 100% of the company. So we're looking for software founders who have decided for whatever reason that they're ready to sell. We really like, and it's a pretty hard requirement, that people help us with a transition period. So anybody that wants to sell a business and then disappear a week later, that's hard to pull off, having, done this a number of times. But we're happy to have a founder who wants to help, sell a business, transition the team, make sure their customers are happy, make sure we know how to operate the business, and then go on and do whatever they want to do. We also are open to founders who want to stick around a little bit longer, but the 100% acquisition is the ideal model for us.
So let me think about, as a company I'm fairly familiar with, it's sort of like the darling of the Toronto Stock Exchange. Every Canadian investor, I think, holds it in their pension plan.
Yep.
It's a company called Constellation.
Yes.
And they are a software holding company, as I understand it.
Yep.
They buy companies. And so they have become like the darling of the stock market for a few reasons. One, they buy cheap. Like they buy at really low, depressed valuations, like really low. And then they raise prices is one of their playbooks. They also scrape dividends. So they buy profitable companies. So they're buying them low. And then they're accretive for their stock because you get to apply sort of like a publicly traded multiple to a fairly small business, which is usually trading at a very low multiple. Yep. So how would your company, Big Band Software, be different than, say, a Constellation?
Great question. So first, I knew exactly where you were going when you mentioned the Toronto Stock Exchange, because I'm a huge fan of Constellation. Mark Leonard, who I think just recently stepped down as CEO, but is still on the board. I read everything he publishes, which unfortunately it boils down to like one letter a quarter, but have been a big fan of theirs for a long time. Now, what is different? They've been doing this for 27 years. And so they've built into this intergalactic scale that's, mind blowing. They're an acquisition machine. Like I think I heard somewhere that they might acquire 160 businesses in a given year. Like that's a scale that like we are not even close. And they, what else is different? Like I think I read that Mark Leonard only sold one business in his career and he regrets it and he's tried to buy it back. Now, cynical Kevin might say, well, it feels like that's kind of marketing. Like, sure, you've had some failures that you could shed, but you don't want to because you want to tell founders I've never sold a business. But like that buy and hold is their model, right? So like I'm a believer in buy and hold. Now where I think our model is a little different, obviously earlier stage, we're newer with the business. We believe in buy and hold, but I like to say buy and hold is a business strategy, not a religion. If we buy a business and we run it for 5-7 years and we think it's worth X, and some strategic acquirer wants to come and will offer us 2 or 3X, whatever we think it's worth, like, I'm going to have that conversation and we might end up selling. But our intent is to buy and hold for as long as we can. So other sort of like, so I'm flattered by the compare. Also, we don't intend to be like a dirt cheap buyer. I would love to buy businesses that are healthy, growing, profitable, and often they command a, pretty nice multiple or premium in the world. And if it fits our model, I'm happy to pay that. So that's the one, so one knock on Constellation is they're like the buyer of last resort, as I've heard them referred to. I don't know if that's fair or unfair, but that's sort of a seller and intermediary box that they could put in. I don't want to be in that box ever. They get knocked for not being able to achieve organic growth. So if you're reading the stock analysts, like that's the one flaw people can find in their model. And our model assumes we can buy a great business from a founder who's ready to move on and then help that business continue to grow. So anyway, lots to like, again, appreciate even the smallest comparison to that company because they're just, it's amazing. It's a money printing machine. And so some of the things that we're trying to do have been informed by Constellation and other holding companies. But yeah, there are some clear differences.
So a skeptical owner might say, okay, so Kevin's going to buy and hold my business. He thinks this is a great asset and he's going to cream off some dividends if we have a profitable year and that's how he makes money. I get it. So a skeptical owner might say, well, like, if it's good enough, Kevin, why wouldn't it be good enough for me? Like, why wouldn't I just hold the business forever? If Kevin's going to hold it, why should he have all the profits? So like, how would you respond to an owner who is sort of in that camp?
I would say that's a great question that you're asking yourself. And I like to say a great business to sell is also a great business to own. So part of what I love about your book and your program is teaching people, built to sell doesn't require that you sell, but you're going to learn the things that make your business less reliant on you, healthier from a profitability standpoint, ready for somebody to buy. But if you decide you want to keep owning it, like that's awesome. Keep doing that. I like to say that there are 100 reasons why people sell a business. Only one of them is money. And as an example, and I don't know if he told this story on your podcast, but you mentioned Arvid and Danielle.
Yeah.
They sold me a business called Feedback Panda.
It's a great episode, by the way. Everybody should go listen to it because it's a really good story. So keep going.
They are two of my favorite people. And so I highly endorse, go listen to that episode. And it was a while ago that I listened to it. So it might have been on that or a different podcast because Arvid is like Mr. Internet. And he's all over the place. At one point, he was telling the story. He actually told me the story privately, but I know he's told it publicly. So that's why I feel it's okay to share. He and Danielle were running this business as a husband and wife team with very few other people. And it was successful. It was growing fast, but growth can create problems and challenges. And they had this asset on their hands that they knew was valuable and it was causing problems in their marriage. And not, sort of just like when you have a business partner, that's hard enough. But when that business partner is also a life partner, it's just complicated. Like there's no other way around it. And so sure. Part of why they decided to sell, back to my point, 100 reasons to sell, only one of them is money. I think they were excited about like de-risking, getting some cash, but also they knew that their marriage would be healthier if they weren't running a business together. But it wasn't a sensible thing for either one or the other to leave the business. So they sold when it was super valuable, very successful. They're completely happy. Like we got to, have a drink a few months later in Europe. And I think it was a great decision for them. And I think it just illustrates the point of like, yeah, some people might have looked at that business and said, it's a great business. It's growing. It's profitable. Why wouldn't I keep it? Well, you might be in a different life circumstance than Danielle and Arvid
I'm laughing at
the time.
I'm laughing, Kevin, because my wife and I we worked together for like an afternoon. Like we lost a bookkeeper or something. And like, this is 20 years ago when we first got married. And like literally she lasted half a day. And when she got home the other day, it's like, never again. I'm never working for you. If it was the last place on earth.
Yeah. I've worked with my wife too, and it lasted a little bit longer than that. And I think if it works, it's great. And if it doesn't, it's probably not worth jeopardizing the life partnership with a business partnership.
100%. So what are some of the other reasons that you see entrepreneurs wanting to sell? You mentioned there are 99 or 100 reasons. Like, what are the most common you hear?
I'm tired. I've been running this business for, 7-10 years, and I don't love it anymore. I have another idea that I would like to focus on, and I know I can't do both at the same time. Sad as it is, John, I've had deals come my way multiple times because somebody died or was about to die. Really, I can't give details on the business because it wouldn't be fair. And we didn't buy it. It was just something that we thought hard about and wanted to. It was a brother was running a business. His wife was not involved, and the CEO died. And so the wife called his brother and said, "Can you please bail me out? I don't even know what this business is. There was no succession plan. You know something about business. Can you help me package this up to sell it?" So I got a call from the surviving brother. Again, we didn't end up doing the deal. I think he got it sold to somebody else who was a better fit. But I mean, that's an example of like, this isn't about money. It's more about life than it is money in a lot of cases.
What is it? What would an entrepreneur say to you that would have you licking your chops thinking, man, this is going to be great. This is going to be an amazing investment as a reason that they're selling? And my follow-up question is, what would they say as a reason they're selling that would make you run the other way?
Well, let me take the more challenging one first, the run the other way. And there's a lot of things that are red flags, I'll say, when somebody's selling a business. We're running out of cash and I need to sell this business in the next month, or XYZ bad things happen. That's a problem. Me and my business partner can't get along. We have to sell this business. Not knowing anything more than a story, it's like, okay, there must be problems inside the business. Otherwise business partners might be happier. So like, I'm going to start asking some questions I want to sell my business. The books aren't really tuned up, but don't worry. It's making money. It's fine. Like that. Okay. Well, that you've introduced a red flag. So, I mean, a lot of the inverse of a lot of what you teach in your book and on this podcast are red flags. So, and I'm not just saying that because you're here. I coach people on some of the same things of like, if you're wanting to sell, do these types of things. Now what gets me excited is somebody who's saying, I have been preparing to sell my business for the last 2 years. I have the right, documentation. I have been removing myself from the day-to-day operations of the business. So either my team or my number two is ready to take over as, leader of the business if you want them to do that. I know the number that's going to make me happy, and I can justify that number with research. I'm not just picking it out of thin air. Those are the types of things that get me excited. Not like, I'm going to get back to like, it sounds weird, John. I would rather pay a healthy number for a business that is healthy, where a lot of people get excited when they hear, this business is in trouble. It's depressed. It's declining in value. Investors want to get bailed out because everybody hates it. Other people might say, I can get it on the cheap. I hear those things and I think I'm buying problems of somebody else's. That's not my ideal situation. I would rather buy something that somebody's in love with. And for one of those other 99 reasons, they've just decided it's time that they hand it off or that they move on. Or that it's time, like, I need help with this. So I'm going to sell it. I'm going to de-risk my personal balance sheet by taking the cash in exchange for my business, but I'll keep running it. I like my job. I like what I do. Like, those are the kind of the contrast of what gets me excited and what are the red flags.
That's super helpful. You talk about the number, and I'd be curious to know how you go about drawing out the number from an entrepreneur you're in front of, because clearly that's part of your criteria is they've clearly thought about the number that they need to be happy, and you know it, and you hear it, and you go, yeah, I can, they're not completely off in la la land. So how do you get that number out of them?
Well, it's not necessarily the goal to get that out of them. That sounds a little bit like unfair. I guess that's not true. Like, there's nothing wrong with asking what's your number, but I typically don't lead with that. What I would like to do is learn about the business, come up with what I think it's worth based on, years of experience and diligence and understanding as much detail as I can, and come up with like a number or range that I feel comfortable with. And I'm happy to like introduce that number first. It's a bit of a dance, right? Some founders we just talked to a guy 2 weeks ago. He's like, here's my business, just gave me like top line profit or EBITDA, and I want this as my exit number. And he was pretty confident, and we were like, okay, well, we'll see if we can get there. Like, let's have a conversation. If people know what they want, that's great, because quickly, are we going to get there or are we not? Or I can get close, but help me bridge the gap, things like that. If somebody doesn't want to share their goal, that's fine, but it's not going to change my analysis of the business. Does that make sense? Like, I'm not going to just come up with a number because that's what you think it's worth. I have to believe in what I think it's worth. And it's super helpful if somebody has done some research, and knows, okay, my business is of this size in this industry. These are the typical multiples that my business will sell for, whether it's a, multiple of EBITDA or a multiple of revenue. On the, listeners of your show are probably more on the small business end. And so, some multiple of profitability to a financial buyer like me. And I know you do a good job of differentiating strategic versus financial buyer. If you have a range that's based in some grounding of fact and research, then that's super helpful to me to know, are we potentially going to find a deal and let's work towards the details, or are we wasting each other's time? And I'm happy for people to approach me, and I never feel like my time is wasted unless somebody has completely unrealistic expectations and they're not letting me know that, if that makes sense.
Absolutely. And this may be putting you on the spot, so forgive me for doing so. But if you've got a business, let's imagine a SaaS company, couple $1 million of ARR, growing at 10% a year, churn less than 15% annually. Like, what kind of numbers would you apply against a business like that? Profitable, let's say it's making 10% EBITDA margins.
Yeah. So, I would say generally the range for SaaS, you're going to, at that size, or maybe a little bit bigger, you're going to see anywhere from like 4 times profits to like the very high end, like 8 or 9. And the business you described in hypotheticals is not at the very high end of that range. I would say there are a couple of groups that do a very good job of publishing. So, and I'd say I'll give a plug to one of the best in terms of transparency. It's MicroAcquire was the brand they launched with. They're now called acquire.com.
Andrew 𝙤𝙇𝙊𝙐𝙇𝙊𝙒, we've had him on the show.
As I was saying this, I'm like, I know John's probably talked to Andrew. So he does this regularly. And I invested in MicroAcquire early. So just as a, full transparency, I'm a fan of Andrew's and the business, but I'm plugging it because they're so transparent. And they say, here's all of our data for e-commerce, for SaaS, for tech-enabled services. And here are the multiples that we are seeing. And so any one of your listeners or readers could go and just like find Andrew 𝙤𝙇 on Twitter. And it's not hard. On their website, acquire.com, it'll say, here's the latest, buy M&A, research that we've done. And so that at least gets people starting to think about like, okay, I'm in this category, and he segments it by size and lots of, different data points. So it's super helpful just to see like, okay, where does this fall? And some have really, really big ranges. So like then you can ask some more questions like, okay, why might one business sell for 2 times profits and one might sell for 10? And where do I fit on that spectrum? So
that's super helpful. We'll put Andrew's website in the show notes as well. Talk to me a little bit about how you get deal flow. So how do you find businesses to buy?
Well, having done this for going on 8 years and bought businesses from 45 different entrepreneurs. I've got a bit of a, reputation in my little segment of the world. There are people like Arvid, who has his own podcast, who talks about his experience. Another guest of yours that I know you've talked to is Tyler Tringus.
Oh,
He
sure.
sold me
Yeah.
a business, and he's got, a following of his own, and people seek him out. He blogged all about the experience, and that was so, there's those things like just a network, and relationships is frankly, the best way to find deal flow. Because if there's somebody who's a friend, or somebody says, hey, I talked to, Laura Roeder, she suggested that I call you. That, going back to your prior question, like, I'm interested. If one of my friends told you to call me, like, you're right to the top of the inbox, and like, let's have a conversation. We also reach out proactively to people that, if I find a business that I like, I won't say the name, but I'm using a piece of software now that I hadn't heard of 6 months ago that I love using as a customer. And so I just emailed the founder last week, and I said, look, I love your business. I'm a happy customer, just FYI, like, high five from Minnesota. And by the way, if you're ever interested in selling, like, please call me, because we love buying businesses like yours. And every once in a while that works. Actually, that's how I got introduced to Danielle, from Feedback Panda, Arvid's partner. She posted something on, I think it was a website called Indie Hackers, which you've talked to them too.
Yeah.
You say it. Just saying, hey, we reached this MRR milestone. Here's how we did it. Here's what's working. Here's what's not. Hopefully other people can learn from this experience. I read it, and I started learning about her business, and I just emailed her. I was like, hey, congratulations. Like, this is awesome what you've built. I love how you're highlighting your customers in your, case studies. And, FYI, we like businesses like yours. And then, fast forward several months, and it was just fortuitous timing. Probably not an accident that Danielle posted that, because they were probably thinking about selling. But so deals come our way because of, me, my team, our reputation, having treated founders really fairly for a long, long time. And then we proactively reach out to folks, and we also follow, the best, brokers and intermediaries in this space. And there are, a few dozen that focus on the niche of software and the size range that we're super interested in. And I love building relationships with those people, so that when they have a deal that fits what we are interested in, we're one of their first calls or emails.
Tell me a little bit more about that experience. In particular, I'm interested in when an entrepreneur comes to you shopping the business. So they've made the proactive decision to sell. They may or may not have engaged an M&A professional, but they are attempting to get the best price by looking or by contacting multiple acquirers. What's your reaction when you learn they're, quote, shopping the business?
I think, great. Like, let's talk. I'm interested. I think it is rare that a business owner would get one email inbound or make one call and a deal gets done. Like, that happens, but if for nothing else, like, test the market, whether with an intermediary or not. If somebody calls me and says, hey, I'm thinking about selling my business, I just assume, okay, you've built a good business. You're a smart person. If I'm interested in your business, you're successful. You're probably smart enough to call a few other people that, also might be interested in your business. So, the notion of like proprietary deal flow, your listeners might have heard, we're like, oh, we've got this secret sauce where only we know about this deal. Okay. If you're in the software space and somebody's selling to you and you don't think Constellation Software has already called them 50 times, you're kidding yourself, because that's how big they are and that's how massive they are. They call every single software company in the world every once in a while. So I just assume people are talking to more than just me. And if somebody's selling to me because I'm their only option, like, that feels kind of weird. So, but that's fine. I'm just interested to talk to people with good businesses, and I don't really, it doesn't matter to me if they're coming through an intermediary or by themselves, sort of shopping it. Like, that's fine.
But how do you win? Because, if I were a different kind of private equity group, like if I was a micro private equity group just set up to flip SaaS companies, as an example, I've got a lot more levers to pull to make money. So I can buy low, because I know I'm going to sell. I'm going to get some multiple expansion. I'm going to sell on the back end, and I'm going to make my money on the back end. So I've got a money making sort of opportunity there. I've also got efficiencies. Like I'm going to grind down all the expenses out of the company, and I'm going to get a whole bunch of efficiencies to make it more profitable. So I'm going to get a spike there. Maybe I'm using a lot of debt, so I'm not putting much equity into the equation. So like, if I wanted to be like a super hardcore shark of a private equity like buyer, I could probably outbid you, if I'm understanding correctly, because your only way to make money is to make money off the profits of the company. So in order to make that make sense, you've got to buy the business for less and hold for a long time. So how do you win when you're competing against guys who are, they're pulling on lots of different levers to make money? Does that make sense?
It makes sense, but let me clarify a couple of things. We have all those levers too. We can buy with debt. We can get multiple expansion. We can, lay off a bunch of people and get higher margins. Like, it's not like those tools are exclusive to, private equity sharks. The difference is we don't have to sell to be really happy with our performance and for our investor groups to be really happy with our performance. Everybody's just aligned around long-term hold. Compounding is a great way to build a really healthy portfolio of businesses. Your earlier question, like if somebody's got a great business and, I want to buy it, well, why wouldn't they just keep it? Like, that's the conversation in my head all the time. Like, if I can buy a great business, build it to be even better, and I don't have to sell it, why not just keep it? Right. So like, we can sell businesses if we want the influx of cash, but we just don't have to. And that's the difference between us and, private equity. And like the shark comment is probably so like, why would somebody sell to us? And like, if I'm, let's say I'm bidding $15 million on a business and somebody can get 20. Well, if somebody's offering 20, they either see something that I didn't see, or maybe they've got a strategic angle. Maybe one of us is not as good at math as the other one. We just see the business differently. And so, John, if you're the founder and my bid is 15 and I'm confident at that, somebody else is going to offer you 20, and that $5 million delta, I mean, that's meaningful money, right? So like you say, I'm going to go with the 20. Cool. I wish you luck. Sorry, it didn't work out for me, but I want you to be happy and successful. And did the $20 million offer come because of debt, or because their plan is to strip out profits, or because their plan is multiple expansion? Like, we could have done all those things in our model to come up with 15. What I'm telling you is like, I'm not just going to bid 21 because somebody else bid 20, because there is, a lot of, either dumb or inexperienced money out there, or people might just have like a different, formula that they're coming up with to bid more than me. Sometimes I'll bid more than other people. I know for a fact, and I can't share specific names here because that would be unfair to the founders who sold. We've acquired businesses often where I wasn't the high bidder. And it's because there's something about like, I treat founders fairly. I have never retraded a deal once I give somebody a letter of intent.
Define retrading for folks.
Yeah, I'm glad you asked. So retrade is sort of like so common in the private equity world that it's accepted as the norm. I think it's kind of a crappy approach. So a retrade would be, I'm going to give you a letter of intent for $20 million to lock you up with exclusivity. So you can't talk to any other sellers for a period of time, like probably minimum 2 months. It might be as long as I had a friend who got locked into a year of exclusivity with a single buyer. And a retrade happens when over the course of that diligence period, I'm learning more about your company. All of a sudden that $20 million offer, and it usually happens to come right before we're supposed to close. Now I'm going to offer you 16 million. And you're so like mentally and emotionally committed to the sale that they're hoping that you're willing to just let that 4 million slide because you don't want to start the whole process over again. I think that's a pretty poor way to treat a founder and a business owner. And I just don't do it. Like I would rather give you the number that I'm going to stick to than, lie to you with a big number, knowing that at the end of the day, I'm going to come down to a smaller number.
One of the other things that private equity groups have become notorious for is, I shouldn't say notorious. I think it's just their business model. They buy 60% of the business, and so they'll throw out a big valuation. Let's just use your 15 and 20 example.
Yeah.
So they'll say, hey, we think your business is great. We want to offer you 20. Now, the deal structure, and you get underneath the sheets, is 12 in cash. You've got to take 8 of the 20 and roll it into equity into a new entity. And that equity, you're now a minority shareholder in their new entity that they're going to build other businesses around and potentially create some efficiencies with the idea of selling that new entity, and you can make off like a bandit with your second tranche of equity, so-called second bite of the apple, which is a terribly overused expression. The challenge, of course, with that is that as a minority shareholder in the new entity, you're just that, a minority shareholder at the whim of the private equity group. You have no rights to typically put your shares onto the private equity group. And so you're just left. In one instance, we did an interview with a guy named Derek Moran. I'll link up to it in the show notes. The guy sold for similar numbers, 20 and 12, I think. I'd have to go back and listen to it. But the 8 that he rolled went to 0 because the guy, the person they brought in to run the company had no idea how to run his business, and it all went poof to 0. So that's the knock against, that's one of the challenges, I think, with selling a private equity group. And I'd just be curious to know if you have sort of comments on have you seen that? What should entrepreneurs be aware of when it comes to that kind of model?
No, I think you teed it up great. I think that happens all the time. Just like retrading happens all the time, like rolling equity, that's part of the playbook. And I would say that's neither good nor bad. Like, to me, this isn't a black and white, like one thing is the right thing to do and the other is the wrong thing to do. It's just, you got to know what you're signing up for. It's a typical risk and reward trade-off. And people need to know, like, do I believe that this company this new owner is the right one to run my company and hopefully get me more money in the future? Or would I rather just have the full 20 million now from somebody else? Or there might be an alternative. So your hypothetical example, let's say it was 20 in total value, 12 in cash. If somebody comes and offers you 16 million, all cash, now you got a decision to make. And neither one of those deals is like better or worse. It's just a trade-off. Like, do I want all the cash now, or do I believe that these people are going to make it bigger? And so I think just being informed about how all this stuff works.
And from what I'm understanding is you would do the latter. You would go in with an all cash offer. And it may be lower at first glance, but the terms may be more favorable.
Or it might be the same. Like, right. Again, to me, the value of the business is the value, and we prefer to be an all cash buyer. And that same hypothetical business, we might be also offering 20 million. And then it probably is an easy decision.
What's the structure of Big Band from the I'm curious to know the legal structure. So some of what I understand to be the way some VC groups work is there's kind of GPs or general partners who run the fund and get a percentage of the fund's sort of assets to administer the fund. And then there are investors who are called limited partners. So their limited downside is whatever they put into the deal. LPs, so GPs and LPs. What's your structure, and how might it be different than a VC firm, for example?
Yeah, no, I'm glad you asked. And private equity is very similar, like general partners, limited partners. The general partner in both a venture capital and a private equity context make money off of fees per year, and then carry, which is typically 20%. Once a deal is sold, 20% goes to the firm after paying off investors. For a lot of the reasons when creating Big Band, I had the opportunity to sort of like get a blank piece of paper and, think about all of my experiences and buying businesses, a little bit of business experience selling businesses, having investors, having business partners say, okay, what do I want this to look like? And I literally was able to start with a clean slate, and, no defined holding period was at the top of my list. Cause as an example, a private equity group that raised money in, say, 2013 is coming to the end of their time where they're obligated to get their investors their money back, because funds usually go 7 to 10 years. as we're recording in the spring of 2023, it's not a great time to be selling businesses because the market's down, debt is super high. You're not getting multiples that you would have gotten in 2021 or 2022. But those people have to sell most of their portfolio. And there's ways around that. But at the end of the day, like you promised people you would take their money, hold it for 10 years, and then give them back all their money. So you're selling in a down market. Congratulations. That's one of a number of reasons why I didn't like that idea. So long hold period. I wanted investors who were believed in that strategy. Buy and hold is a business strategy. It is not a religion. I'm going to trademark that someday. And the fee structure that you described creates an incentive to just raise more and more funds. And here's one of the dirty little secrets about venture capital and private equity. They end up there's a reason they keep raising bigger and bigger funds. And it's because you get bigger and bigger fees to pay the bigger and bigger teams. And again, that's not like good nor bad. It just is what it is. And when I went to my team and my investors, I said, here's what I want to do. I want to build a big holding company that, 27 years from now looks something like Constellation, but with the differences that I already described. Like we want to create our own reputation and brand about treating founders well, paying fair prices. Maybe we'll sell something if it's a great deal, but like we just make smart business decisions based on the needs of that business, not on some fun timing. And I said that the 2 and 20 model does not incentivize the right behavior. It incentivizes like raise more and more funds that are bigger and bigger and sell every business you can after a short holding period. I'm like, for a number of reasons, that's not what I want to do. So here's the salary that I think is fair to me and a small team of starting people. Here's the equity that I think is fair to me and that team of people. And here's the equity left over for investors. And here's the fund that we want to raise. And part of our model, John, is how do you make money? Well, we make money from the profits of the portfolio, but it's not getting distributed. Those profits go back up to the holding company to facilitate more acquisitions. So structure, it is a holding company, and there are different flavors of that, but it is not a fund. My team has a fair amount of equity with the opportunity to earn even more if we perform really well. Our investors have invested money with no expectation of when they're going to see that money back. And we all just believe in the model.
I'm going to ask you some questions that might get uncomfortable. So if they do, you can just tell me where to go. But the reason I'm asking is I would love for people to understand, really get inside your head as they think about approaching people like you, a business, an acquirer of a business that's listening to the show. What proportion of your net worth would you have invested in Big Band? Like, I know you've got a home that you own and you probably got some stocks in the stock market, but like, what proportion of your net worth would be in Big Band?
Would be easiest as much as possible right now. And it's a little bit of a, the only answer I can give is what's right for Kevin. I believe in myself. I believe in my team. Have done this for a long time. Big Band is a new business, but it's not a new concept to me. And so I have an unfair information advantage in order to invest probably more than any reasonable financial advisor would recommend to advise in a private enterprise like this. I have friends who have similar models, like a good friend who's building an e-commerce holding company or somebody that's building a brick and mortar holding company. I wouldn't invest the same percentage of my net worth into their businesses, even though they're friends, even though the model's the same, because I don't have the same information advantage and I don't have the same ability to influence the outcome, if that makes sense.
100%.
So I don't know if you're asking for, we're not seeking investors. Like we've got all the money we need for right now. Even friends and family would have to like talk me into investing. It's like, yeah, go ahead.
No, the reason I'm asking is I want to get a sense of how much skin you have in the game. So for example, I think some of these professional private equity groups, like kind of the brand name private equity groups that people are aware of, I mean, the people who work in those companies are salaried professionals. They are incentivized to make good investments, and they have variable compensation plans that are commensurate with their role. Yet my sense is that they are salaried people. like it's like working at Goldman Sachs or working at JP Morgan or working at Bank of America. You don't kind of think about it on the weekend. Like you go home, you leave, and your job is done. And you get up the next morning, you go back to work. My sense is that someone like you who's starting a fund may have a bit more skin in the game, and that you're not necessarily going home at night and flipping on the football game and like kind of checking out. Like you're a little more dialed in because am I getting that wrong? Maybe
no, you're right.
Your network.
No, it's a like probably a overweighted proportion of my network.
More than half.
I'm recording from my house. Like I own a house in Minnesota and this. Now I've got some like long-term retirement, but like you make a very good point that I love connecting. Let me say it this way. I love connecting with founders of businesses or owners of businesses because I know how that feels. I am an owner of Big Band. I have started other businesses in the past, some successful, some less successful. I fall asleep every night thinking about my business, and I wake up every morning thinking about my business. And I am very thoughtful and protective of like life-work balance. I have a wife and 4 kids, and it's not like I'm a workaholic. But when you're a business owner, people, I think, will hear this and understand, like you can't shut it off. And I think your point, I have been the salary guy too. And it was easier to shut that. Like if the business failed, I didn't fail personally and financially. So yes, there was a different level of commitment. And there are some like private equity and venture capital people who have invested in their own funds. So it's not like exclusive to me or holding companies, but I assume you're asking because like that might matter to some people selling a business. Like, am I selling to somebody who is going to take my business, my baby, to use, another potentially overused term, and care about it as much as I do or I did, and I should in the future. Another thing that I like to share with business owners is like, you're tied to your business long after you sell it, for better and for worse. Like it is your legacy. It's something you're going to tell people about. Like, even if you're not actively running it, you say, oh, I built this business and I sold it. You're going to say that forever. And if you sell it to somebody who doesn't do right by your legacy, that's going to not feel good. Even if maybe you got a few extra bucks in the transaction. So I think I was so excited to come on this show because you ask all the right questions and have all these insights. But, I've got plenty of skin in the game. And if Big Band fails, I don't have this house anymore.
That goes to the question I was going to ask next, which is who collateralizes the debt? So I know buying businesses, you have to use debt to make it work. So how much debt would you typically use on a deal to execute it?
So right now, 0. Like we're buying in all cash that is committed cash from investors. The plan is to, build a healthy portfolio that is profitable and diversified and healthy. And then we might layer some debt on the holding company itself just to, give more flexibility, better returns. But when we make offers, it's not with like X% of equity and X% of debt, because that, I would rather reduce our risk in the near term, confidently tell a founder, this is my number. You don't have to rely on me raising money from anybody else or convincing a bank to loan me the money. I have this money in an account that I could give you next week if that's as fast as we choose to close.
Got it. And if you were to lever up the hold co and put some debt on top of the holding company, would you be required to sign a personal guarantee for that debt?
Well, I don't want to speak for hypothetical banks that we're talking to, but like I probably would not. We've got plenty of cash. We would have, healthy companies. I have signed personal guarantees in the past, but that is not built into our model.
I heard about a story. To this day, I shake my head and go, that can't be possible. But let me walk you through the economics and tell me if you think this is as insane as I think it is. So it was one of these PE deals where the private equity group was going in and saying, "Hey, we're flashing a big valuation, whatever it is. Let's just use 20 million for the sake of our conversation." It wasn't that, but it doesn't really matter. We're going to give you 12 up front, and you're going to ask you to roll 8. Now, to make this make sense and really make that 8 million that you're leaving into the business really, jack up the return, we're going to take on some debt and buy some other businesses. Now, they wanted the owner to personally guarantee the debt that the private equity group was taking on in order to grow the company. Can you like I've equated it to the idea of like selling your home and then like I can't even actually equate it to selling your like it makes no sense. Have you ever heard of a deal structure like that?
No. Did the person do the deal or did they run away?
I think they did. It was a guy. Yeah. Again, I don't have firsthand knowledge of it, so I've heard of that through somebody. But it to this day, it blows my mind. But it speaks to the importance of understanding if you are going to sell to a private equity group, what is the debt load that they are going to use? Because whether or not you have to personally guarantee the debt, which would be unusual. Again, I haven't heard of it since. Your company will certainly have to pay off the debt, entity. Which puts risk on the next, next exit or the next, distribution and so on and so forth. So no, I've never heard of that. I think that is really terrible if that actually happened. It was a true story. Not that I doubt you sharing it, but obviously it's secondhand knowledge. It's secondhand.
So no, that's not the way the world can and should work. And I think the important lesson is like, ask the right questions. And somebody selling a business has every right to know, are you buying this with cash? Are you buying it with debt? What is the plan? How does your debt work? If you are a fund, which we are not, but if you're a fund, a really good question for people to ask is like, where are you in your fund life cycle? So are you in year 1 of a 10-year fund? Are you in year 6 of a 10-year fund? Because that informs. How would that inform? What would you interpret to mean to take away from that? So if somebody's selling for all cash, it doesn't really matter. It matters if I'm selling to somebody who I hope owns my business for a long, long time, but and that's part of their argument for why they're a good buyer. But my fund runs out. Same conversation. Remember I said if somebody started a fund in 2020 or 2013, they're at the point where they have to sell everything. Well, if you're 6 years into a 10-year fund, like you can only hold this business for 2 or 3 years before you have to market it and sell it. So if as a seller, I care who owns my business and I don't want to see somebody else own it in 4 years. Now I've got some information that I can weigh, like, does this matter to me? If I'm being asked to roll equity in your, previous examples, okay, well, how long do you intend to hold this business and then sell it to somebody else so I can get that, second check? If there's debt involved, you need to ask a lot of really hard pointed questions about
like what?
Well, just how much debt, 20 million. If it's, you're putting 12 in cash and asking me to roll 8, but your 12 is actually 3% cash and 9% debt. All of a sudden, this business that I was running that we've agreed is worth $20 million has 9% debt loaded onto it. That
what
means
do you mean by 9% debt?
I'm sorry, not 9%, 9 million. So again, like, let's say, John, your business is worth, we say the valuation is 20 million. You're going to take 12 in cash, but you're rolling 8. But the cash I've given you is actually 3% of real cash from me and
3 million in real cash.
3 million in real cash. Thank you. 9 million in debt from some bank.
Why do I care? If I'm the seller, I'm getting my 12 million. Like, why do I care that you're getting 9 million of it from a bank?
Because 8 million in your value is now tied into this business that owes you 8 million, but it owes the bank 9 million first. So the profits from the company are going to service that 9 million in debt, and you got to pay that down and then sell it. Or when you sell it, you got to pay off the 9 million first. So if you believe in the model, like to me, that's just a material difference in whether somebody, or if it's, and actually this is where it gets tricky and hard, and where like a really good advisor in a complex situation like that is very good. Because somebody might say, well, no, I'm giving you 12 million in cash. It's not financed at all. Your 8 million is the first debt that we owe when we sell the business. but they could go 6 months or a year later and layer debt onto the business. You can't stop them because you're a minority owner, but all of a sudden you're behind a bank when the, selling happens. So for a lot of those reasons, like the traditional sell to private equity, roll equity, it almost always shows a big number, but there are complications that people need to know what they're signing up for and know if they have any ability to block those, pitfalls down the road, or if they just have to sit and take it and hope it works out.
Yeah. The other one that I think I hear a lot about is that private equity buyers sort of scrape the soul out of a company. I actually read an article over the weekend. There's a company based in Toronto called Gluskin Chef, run by a guy named Ira Gluskin, founded by a guy. They were a wealth management company. They did investment management, retail investment management, and some institutional stuff. In any event, Ira Gluskin, and I wrote it down because I wanted to make sure I got the quote right, said he sold his company to private equity, Onyx, which is a large private equity group. And he said, quote, they deserve to go bankrupt. This was 5 years after he sold his company. And he went on to talk about them basically just completely, gutting the soul of the company. And that's from a founder who sold, was totally out, but was, was lamenting his decision to sell to a private equity group. And so I think these deals can work out tremendously well. And there are circumstances where a founder feels like the buyer didn't honor the soul of the company.
Yeah.
I'd be curious to know your thoughts on that, what you would coach owners to think about as it relates to this risk of losing the soul of your company.
I have a lot of thoughts on that. Unfortunately, when you sell a business and you're either completely bought out or in a minority position, you're no longer the decision maker. You have to accept that it might be run differently than you would run it. And that could include everything as small as like changing the logo to scraping out the soul of the company. But like when you sell, you need to accept that somebody else is making the decisions and you may not agree with all of those decisions. And if you can't live with somebody else making decisions on your company and running it differently than it might not be the right time for you to sell. So that is an important thing to think about when approaching, thinking about selling a business. I would say, like, I don't know anything about this, Ira person, or Onyx. I worry that they're really good, kind, honest, smart people that work in private equity firms. So I don't want to paint the whole industry with a negative brush. I do think it's important. These conversations are important for, owners to listen to and to ask the right questions or to think about. So like selling to private equity is not necessarily bad. Again, I have friends that run private equity firms, but there are different flavors, just like with anything else. Like I run a software holding company. There are different flavors of ours. I believe we do things the right way and treat people really well and honor the, legacy of their company. And people are going to be proud to have sold to my business. I think there are other people that run software holding companies that take the opposite approach. And one specifically that I know and I won't name, their model, and I think they tell founders this, so it's not a surprise, fire everybody. All the dev and customer support goes to, offshore people that cost, 20% less. They tell their customers, we are no longer, putting out new features. We're going to raise prices 20%. I dare you to leave. And that's just their model. So like on paper, we look sort of similar, like software holding company, buy and hold, but like very different owner experience when selling to me versus that other company. And so it's not as simple as like sell to this category of people. And we briefly touched on like strategic acquirers, which I know you've had some in your, seller or buyer series. Like that's a whole category. You talk about that a lot. And like that for sellers aiming at that makes perfect sense. There are good experiences and there are bad experiences. There are good and bad experiences selling to somebody with a holding company model. There are good and bad experiences selling to private equity. There are good and bad experiences with, I don't want to sell at all. I'm just going to keep holding my company. And so I think the best thing people can do is know what questions to ask, talk to people who've done it before, get the right advice, whether you actually hire an intermediary or you talk to other people. I'm a big fan of, before we started recording, I think you mentioned Entrepreneurs Organization. There's YPO, there's Vistage. You probably could find some like regional based things where you like have peer groups of business owners. Like that's an amazing place to just get connected with other people in a similar situation, whether they've sold a business or they haven't, and just like understand these stories. So that you're not surprised with and you actually know the questions to ask about like rolling equity or debt or like, how does a transition period work when I've sold, but you're still asking me to help transition, like I mentioned before. Corollary to that is like, start that process early. I coach people all the time, like start thinking about these things, even if you don't intend to sell for another 3 years or 5 years, because one, things can change. Life circumstances can change. And all of a sudden you might have to sell, or you might want to sell earlier than you thought. So it's never too early to start educating yourself on these things as a business owner. And you get this education built up over time so that what might be foreign concepts that we're talking about right now, 2 years, 3 years down the road, you're very conversant in these things and you know what questions to ask and you approach it with more of a confident, you're not at so much of an information disadvantage when you're going to sell.
I was talking to one entrepreneur who classified a sellable company or a built to sell company as he characterized it as the perfect insurance policy. So to your point, you shared a story early, the death of one of the partners. I mean, no one expects to die. No one likes to think about life insurance, but ultimately having a company that is sellable gives you an insurance policy so that if something life changes, some life event happens to you for whatever, good or bad, you've got an asset you can sell. And you're absolutely right. I don't want to leave our listeners with the impression that selling to a private equity group is bad. I think we've had lots of amazing success stories. I think of one last week, we interviewed the founder of Tula, who skincare, 9-figure business, huge exit. He sold part of his business to a private equity group, and they were instrumental in getting him to a massive exit. So probably would never have happened had it not been for them. So for sure, we should not, you're absolutely right to point out, we should not make this pissing on the private equity community. That's not the intent of the episode. But
I brought that up so people don't get mad at me.
But it's true. I think you have to know but those stories are out there. Unfortunately, the sad stories are more common than or maybe just more talked about than the super successful more talked ones. About. I think, I wanted to focus on this word soul because to me, that is the essence. Sure, there are situations where, like Brian Moran, where the private equity company came in and the business failed after they owned it. Bad business strategy, bring in the wrong people. I get it. That
stuff happens.
That stuff happens, right? But the word soul is a very emotive word, which I think goes to illustrate the pangs in one's gut when a decision is made that is counter to somebody's value system, the soul of the company. We did one interview with, this goes back to 2018 or so. I'll put it in the show notes. Her name is Sherry Deutschman, and she built a company based on a profit sharing plan for her employees. She had a very a lot of low paid employees for whom the profit sharing plan, the monthly profit sharing plan, became a significant part of their compensation. In the early days, she believed, in her gut, going back to soul, to really give a little bit of the profits to these people that made no money, $8 an hour, $10 an hour, working in a factory setting. But so in the early days, these checks were, $12 a month and $16. Yeah. But over time, as the business grew and successful, these sort of blue collar workers and these frontline people were getting checks of $180 or $240 a month. And it became a meaningful part of their amount of money they needed to live on. And she sold a private equity group. And of course, they did the spreadsheet and they said, oh, well, if we strip out the variable compensation, this incentive program you've got for, we save 12% and our return on investment goes, up to 16 and our investors will love us. And so get rid of the variable compensation. And Sherry's like, no, you can't get rid of that. That's like part of the DNA of the company.
Yeah.
And they're like, no, but if you can look at the spreadsheet here, if we just take out that 12% and our ROI goes for 68 or whatever. And she's like, no, that's the soul. Anyways, they stripped it out. She left. It was a terrible experience for her and she regrets the decision to this day. So there are those stories. But to me, I think it goes down to like for Sherry, that was part of her soul. Like that was not a business decision. It was a personal value that she felt she needed to give.
What's like a core value of the company itself.
Core value.
Like there were probably people that came to work at that company specifically because of this thing, or certainly people that had grown up with a company that got like that was part of their compensation. And so to think that you just strip that out and like everything's fine, might have been a little delusional, again, not knowing all the details, but, that's messing with people's compensation is not a trivial matter. And it doesn't make it less trivial because it's somebody making less per hour. It might even be more important that they have
it may be more
money.
Important. Yeah. But it goes to your point earlier, which is if you sell, you have to be comfortable with the fact that you've sold. And decisions, even ones that might affect the soul of the company, are now not in your control. Mm-hmm. And so I think founders need to understand, if there is a part of the soul of their company they don't want changed, having a really candid conversation with the new buyer up front to find out what their intention is, how they feel about it, if they deeply understand the soul. And even still, you might sell and they might change it. So you kind of have to roll the dice.
You have to sell to somebody that you trust that is going to be a good steward of your company. You still have to be accepting that they might do things differently than you. But I think that's a really important thing is like just, knowing who's going to be the custodian in your business and believing that they're going to, do the right thing more than they do the wrong thing. And you got to be willing to take that chance. I'm reminded of a different Sherry who was a friend of mine, 𝙎𝙊𝙐𝙇𝙊𝙐. Tell me if you've
heard Rob Walling's wife.
Yeah. Right. Yeah. So Sherry is a clinical psychologist or psychiatrist. They can never remember the difference, but she's written about, and I got to see her do a talk, I think at one of Rob's conferences, MicroConf, about... Yeah,
we should be clear. Rob Walling is the founder of Drip. He also runs an investment program called Tiny Seed.
Yep.
Some people may know his podcast, Startups for the Rest of Us, which is a tremendous podcast. I recommend everybody take a listen to that. And his wife is Sherry Walling, who works with entrepreneurs on transition issues, as I understand it. You know better than I.
Well, Sherry's got a amazing career in her own right, and they're sort of a power couple. But I bring her up because she did an amazing talk about founder psychology, and I'm going to butcher it, but I'll get you the links to put in the show notes and get the meat of either the study or Sherry's talk. Sherry's talk is probably more consumable, but what I remember from it was they, wired up, people's brains so they could see the brain activity, and they're showing founders, like, let's say it's me, you're showing the founder a picture of their kids, picture of their kids, picture of the kids, and then the company logo, and kids, and company. And there were good and bad things. So we're trying to measure what triggers positive brain response and what triggers negative brain response. And the super interesting takeaway from this, it sounds as I'm listening to this as a father, I'm like, no way. But I believe in science. So the big takeaway was the company images and logos triggered very similar response as the child, images and those sorts of things. And so, people say like selling my business is like giving up my baby. Like that's not just an expression. And so, couple of, things to take away from that. One, like hard to argue with science, but I do believe, like I put my kids in an entirely different category than my business. And you've heard me talk about how much I love my business. I try to be conscious and healthy about that. And, when thinking about selling, like that's there's a piece of you that's gone. There's a piece of your identity that changes indefinite, like forever. And being ready, having a built to sell business so that it's that insurance policy, and you can be ready in a hurry, even if you don't think you want to sell it in the future. And knowing like if that part of my identity is gone or different, like then what? Who am I? Which is a real question. Like I know other founders who've sold businesses, huge outcomes, like super successful. Actually, there's some very public ones that are very tragic, where now that I'm not the owner and the founder of this company, I don't know who I am. I'm a little bit lost. I don't know what my next thing is. So I bring that up because it was super interesting. Sherry's a friend, and it sort of related to this like soul of the company and what are my core values and the company's core values. But it's also just like to illustrate, again, my point, like selling a business is, only one reason is money. And this is very complicated. And I think the best thing that owners can do is prepare, think about it, read, listen to experts, connect with other, owners, both post-exit, pre-exit, early stage, and just like be, maybe a little vulnerable and open and honest with one another, and just say like, I think I want to sell, but maybe I'm a little scared because I don't know what I'm going to do. And I've been working my butt off for X number of years. And if I have all this free time, like, then what? And, like those are some of the real conversations that people should have with loved ones and trusted, friends, or if nothing else in your own head, because that stuff becomes, really important and really complicated when you go to sell.
Yeah. I'm a big believer in having some pull factor, something that you want to go do next that is pulling you towards a new business or a new venture, a new something, because you're right. It can leave people feeling empty if they haven't really thought about their next chapter in clear detail. I could chat with you, Kevin, all day long. So we'll have to do this again sometime. It was great. Having, again, I've heard your name from Laura, former guest, Arvid and Danielle. You mentioned Tyler I'd forgotten about, but these are all people whose businesses
anybody I bring up, you've interviewed them. So you know all my friends.
Yeah, it's great, and it's cool that our guests are selling to you and people like you. So that's fantastic. Just tell people where the best place to reach you is online. What's the best way to reach out? Yeah,
bigbandsoftware.com. If you want to say hi, if you're listening to this, we're looking for great businesses and great team members to join. We've got a newsletter that I'm pretty proud of, where we just share our own thoughts. We link to other people's thoughts, link to podcasts that we've either been on or that we love the message, et cetera, et cetera. Try to just be a giver in the universe without expecting anything in return. And if people want to connect and follow me, Twitter's my platform of choice, and it's Kevin_McArdle. And I know you'll link to it, but McArdle has one C, and love connecting with business owners or anybody out there in the world, giving it their best shot.
And Kevin will put all that in the show notes at builttosell.com. Thanks for doing this.
Thanks, John. It's been a lot of fun.